Monday morning, silver opened at $76. Friday evening, silver closed at $75, $1 lower, 1 week gone. Most people looked at that and thought nothing happened. But here's what actually happened inside that $1 move. The Federal Reserve had its most divided vote since 1992. A sitting Fed chair publicly accused the U.S. President's administration of undermining the institution in his final press conference on the way out the door. Inflation data delivered what analysts called a hawkish double punch. The U.S. economy posted its second consecutive quarter of slowing growth. Japan intervened in currency markets for the first time in nearly 2 years. And for tech companies, Google, Amazon, Microsoft, and Meta collectively announced $725 billion in AI infrastructure spending for 2026, a 77% increase over last year's record. All of that inside $1 in 5 days. And most of the silver content you'll find this week will show you those 5 events one at a time, as if they're separate stories. The Fed votes over here, the inflation data over there, Japan is in a different corner. Big tech earnings on a different shelf. That's not how markets work. None of those events are separate. They are all chapters of the same story. And when you read that story in the right sequence, from chapter 1 to chapter 5, silver sitting at $75 on a Friday evening stops looking like nothing happened and starts looking like something very specific is being loaded. I'm going to walk you through every chapter today. Real data, real events, real dates, no hype. By the time we're done, you'll have a clear-eyed picture of exactly what held silver back this week, exactly what's pulling it forward, and exactly what to watch over the next 2 weeks. Because those 2 weeks might be the most consequential for silver in all of 2026. Let's go. Wednesday, April 29th. The Federal Open Market Committee voted to hold interest rates unchanged at 3.5% to 3.75%. Nobody was surprised by that decision. The market had priced in a 100% probability of no change going into the meeting. What the market had not priced in was the vote count. 8 members voted to hold, 4 dissented, an 8-4 split. And here's the part that should stop you. That is the most divided Federal Reserve vote since October 1992. Over 30 years of modern central banking. And this week's meeting produced the largest internal disagreement the institution has seen in that entire stretch. But it gets more interesting than just the number. Because those 4 dissenters weren't all pulling in the same direction. 3 of them, Beth Hammack, Neil Kashkari, and Lori Logan, voted against the decision because they thought the statement was too soft. They wanted to strip out any language even hinting that rate cuts might eventually come. They want the Fed to say, clearly and without softness, we are not cutting. Don't expect it. One of them, Stephen Moran, voted the exact opposite direction. He wanted to cut rates right now. At this meeting, he believes the economy is already slowing fast enough that easing should have started already. So you had the committee simultaneously being pulled toward we might need to hike and we should already be cutting. And the 8-member majority tried to hold a compromise position in the middle that neither side accepted. The dollar surged on Wednesday after the statement dropped. Silver fell to around $71 to $72. That's the immediate reaction when markets read the Fed as leaning hawkish. Non-yielding assets like silver take a hit because a higher for longer rate environment makes dollar-denominated instruments more attractive by comparison. But here's what most silver coverage completely missed about this meeting. It wasn't just the vote, it was what Powell said in his final press conference as Fed chair. He confirmed he is staying on the Federal Reserve Board of Governors after his chairmanship ends on May 15th. And he explained why. Powell signaled his intention to serve as a governor rather than depart, noting he is waiting until an investigation into Federal Reserve renovations is completed with transparency and finality. But the deeper message, the one global investors heard clearly, was institutional. By staying on the board, Powell ensures that the incoming chair, Kevin Warsh, who is advancing through Senate confirmation this week, does not immediately reshape the institution without any counterweight from the previous leadership. Counting Warsh, the president would have 3 appointees on the 7-member board. Powell staying means that balance is not immediately tipped. What does any of this mean for silver? Here's the quiet truth that sophisticated investors understand. When a central bank's internal unity fractures publicly, when a departing chair signals that institutional independence is under political contest, global investors don't panic. They quietly, incrementally shift a portion of their portfolio toward assets that don't depend on any central bank's credibility to hold value. That's gold. That's silver. Not dramatically, not immediately, but the direction of that flow is consistent with institutional stress. For most of his 8 years as chair, Powell maintained strong consensus among the committee, even as the Fed struggled to contain inflation and resist aggressive White House political pressure. The 8-4 split broke that era, and markets noticed. The Warsh era begins May 15th. His first full FOMC meeting is June. Morgan Stanley now expects the Fed to defer rate cuts until 2027, staying put throughout 2026. That's the new baseline. But Warsh's early public statements will tell us whether he's going to maintain that posture or pivot toward the easing the White House has been publicly pushing for. Every Thursday morning, April 30th, 3 major economic data releases dropped simultaneously at 8:30 a.m. Eastern. The one that mattered most for silver, core PCE, the Federal Reserve's preferred inflation measurement, came in above expectations for March. The headline Consumer Price Index had already jumped to 3.3% in March, and some economists believe it will soar to 4.2% by the end of the year. The core PCE print confirmed that it isn't an outlier. Inflation is not cooling, it's grinding higher. At the same time, initial jobless claims came in near their lowest levels in decades. The labor market remains remarkably resilient. People have jobs. Businesses are still hiring. There's no employment crisis forcing the Fed's hand. And there's the trap. The Federal Reserve has 2 jobs. Keep inflation near 2%, keep employment healthy. When both mandates are pulling in the same direction, low inflation, healthy jobs, the Fed has room to ease. When inflation is elevated and employment is strong, the Fed is stuck. It can't cut to support an economy that doesn't need cutting. It can't ignore inflation that's above target. It holds, and it holds longer than anyone wants. That's exactly where we are. And those 2 data points together, rising core inflation, near historically low jobless claims, handed the hawkish members of the FOMC everything they needed to justify their dissenting votes. The case for cutting has not strengthened. The case for holding or even tightening just got stronger. Morgan Stanley pushing its first rate cut forecast to 2027 was the headline. Traders actually began pricing in the possibility of a rate hike in 2027, not a cut, a hike. That is a significant shift in how the market is mentally modeling the future. Now, here's the part you need to hold alongside that. The inflation we're seeing right now is not broad-based structural inflation. It is overwhelmingly driven by energy prices. Policymakers face an economic climate where inflation has held above the Fed's 2% target, as tariffs and soaring energy prices are complicating policy. Normally, the Fed would look through temporary price shocks from both factors, but the duration of the surges has raised concern about a longer-lasting consumer impact. The Strait of Hormuz, the narrow waterway connecting the Persian Gulf to global shipping lanes, has been effectively closed to commercial traffic since the U.S.-Iran conflict escalated in late February. Brent crude, above $100 for an extended period, flows directly into every corner of the economy: shipping, manufacturing, agriculture, and consumer prices at the pump. But strip out energy and food, and core inflation is elevated, but not catastrophically so. This matters enormously for the silver thesis, because oil-driven inflation has a specific endpoint in a way that wage inflation or demand inflation does not. When the strait reopens, and it will, because the economic pressure of sustained 100-plus oil becomes unbearable for every government involved, energy prices can correct quickly. And when energy corrects quickly, the inflation reading that's been tying the Fed's hands can shift dramatically within a single reporting cycle. Watch what happens to oil, because oil right now is the master variable. Everything downstream, inflation, Fed policy, dollar strength silver, responds to it. Also on Thursday morning, Q1 2026 GDP landed at 2% annualized growth, below the 2.3% forecast, below the 2.1% average for all of 2025, and well below the 4.4% growth of Q3 last year before the Iran conflict reshaped energy markets. The standard headline reaction: economy slowing, rate cuts might come sooner. Silver bounced slightly after the print. Then the hawkish FOMC tone reasserted itself, and silver gave back most of that gain. But here's the thing that almost nobody is talking about. Silver took the time to mention. Look inside the GDP number, not just at the headline, because what sustained that 2% growth rate, the single largest positive contributor, was investment in AI infrastructure. Data centers, servers, computing equipment, software. Oxford Economics chief economist said explicitly after the release that the core of the economy remained solid in Q1, driven by the AI build-out. AI infrastructure is what kept the U.S. economy growing at all in Q1 2026. And AI infrastructure runs on silver, not symbolically, physically. Silver is the best electrical conductor on Earth. It's a material science fact. In the highest performance, highest reliability components, the connectors, the contacts, the power distribution systems inside data centers running 24/7 under enormous thermal load. Silver is not a preference. It's a requirement. Engineers don't substitute copper in these applications and accept performance degradation. They use what works. And here's the critical thing about AI data center demand for silver that separates it from every other silver demand story. It is essentially inelastic to price. If silver goes from $75 to $100 to $150, it doesn't change how many ounces Amazon orders for its next facility. Silver is a rounding error in a $200 billion capex budget. The decision to build is made at the strategic level. The silver gets purchased as a consequence of that decision, regardless of its price. That inelasticity is the whole story. And it brings us directly to Chapter 4. Wednesday evening, April 29th. 4 companies reported earnings almost simultaneously. Alphabet, Amazon, Microsoft, and Meta. Every one of them raised their capital expenditure guidance for 2026. Here are the actual confirmed numbers. Google, Amazon, Microsoft, and Meta collectively plan to spend $725 billion on capital expenditures in 2026, up 77% from last year's record $410 billion. Let me put that in context. $725 billion in a single year. From 4 companies, Amazon's Q1 capex alone hit $35.67 billion. Alphabet confirmed full-year capex of $180 to $190 billion. Microsoft raised its forecast to $190 billion, including $25 billion attributable to higher component pricing. Meta raised its full-year range to $125 to $145 billion. It was up $10 billion at both ends. Microsoft disclosed an $80 billion backlog of Azure orders that cannot be fulfilled due to power constraints, suggesting demand is outpacing even its aggressive build-out pace. All the hyperscalers report their markets are supply constrained, rather than demand constrained. Read that last line again. Supply constrained, not demand constrained. These companies are not building because they're hoping customers show up. Customers are already there, waiting, and the bottleneck is the company's ability to build fast enough. Now, $725 billion of AI infrastructure, what does it consume? Chips, obviously, power, obviously, but also silver, and power distribution systems, and high-performance connectors, and thermal management equipment, and the components that allow a data center running around the clock at high heat to do so without degradation. Approximately 75% of aggregate hyperscaler capex in 2026 is estimated to fund AI-related infrastructure, representing roughly $450 billion in AI-specific spending. $450 billion in AI-specific infrastructure spending. And silver demand inside that spending is completely insensitive to silver's price. These companies are not tracking the silver market. They are building, and silver is a cost of building, and it will be purchased regardless of whether silver is at $75 or $150. Here is the number that ties this directly to the week. Meta cited higher component pricing, particularly for memory, alongside growing competition for land, power, and skilled workers needed to build data centers as reasons for raising its guidance. Higher component pricing. They raised their budget because components cost more, and they raised the budget anyway. That's inelastic demand in action. You don't walk away from a strategic infrastructure race because your inputs got more expensive. You adjust your budget and you keep building. The AI infrastructure build-out just confirmed that it is not slowing. It is accelerating. The 2026 number is 77% above the 2025 record, and the companies building it are already signaling that 2027 will go higher still. Alphabet's CFO confirmed 2027 capex is expected to significantly increase. There is a structural, growing, inelastic demand floor under the silver market that is being reinforced every quarter by corporate earnings releases. And the week of April 28th to May 2nd just made that floor higher. By Wednesday evening, silver was sitting around $71 to $72. The FOMC hawkishness had done its work. Then Thursday happened in Tokyo. Japan intervened to prop up the yen against the US dollar on Thursday, April 30th, its first official currency action in nearly 2 years, sending the Japanese currency up by as much as 3%. Japan's top currency diplomat Atsushi Mimura had said the timing to take decisive action was approaching, calling moves in the currency market extremely speculative. The Ministry of Finance stated that action could be on all fronts. "This is our final evacuation warning to markets," Mimura told reporters, and then they followed through. The dollar initially fell to 155.5 yen after the intervention, its lowest since March the 2nd, on track for its largest single-day drop since December 2022. When the dollar drops sharply, precious metals immediately get a bid. Silver climbed back above $74 on Thursday, extending gains through Friday's close at $75. Without Japan's intervention, silver likely closes the week at $71 or $72, well below where the structural story says it should be. Japan's decision, made for entirely domestic reasons, protecting the yen from speculative pressure and shielding Japanese households from amplified energy import costs, accidentally rescued silver's weekly close. Now, here's the thing I want you to take from Chapter 5 that goes beyond this specific week. The yen had fallen more than 2% since the US-Iran conflict began on February 28th. The Bank of Japan had signaled it could raise rates in coming months, Investors were watching whether Japanese authorities would step in around the critical 160 yen per dollar level. Japan has now drawn a line, and that line creates a recurring dynamic. Every time the dollar strengthens enough to push USD JPY back toward 160, Japan has every incentive to intervene again. Each intervention sends the dollar lower. Each dollar decline creates a window for silver to recover. The dollar, silver's most immediate short-term suppressor, is not only under pressure from the Fed's eventual policy pivot, it is under pressure from every major economy that is simultaneously absorbing expensive oil imports priced in dollars and watching its own currency weaken against a strong greenback. Japan's intervention came as the standoff between the US and Iran has heightened inflation risks and dashed hopes for rate cuts from central banks across the world. Japan was not the last central bank that will feel that pressure. Europe is feeling it, India is feeling it, China manages it differently but feels it too. The dollar faces multiple sources of pressure, not just the Federal Reserve, and each of those pressure sources represents a potential catalyst for silver that has nothing to do with the Strait of Hormuz reopening or the Fed pivoting. That's Chapter 5. Tokyo saved silver's week, and it reminded us that silver's path higher doesn't run through one door. I want to take a moment to step back, because I think the most valuable thing I can give you right now is the connective tissue between those 5 events. Everything that happened this week traces back to one root cause: the US-Iran conflict and the Strait of Hormuz closure. That single geopolitical event is the source of Brent crude above $100, feeding the inflation data that delivered the hawkish double punch. The elevated inflation that is tying the Fed's hands and keeping rates higher than they'd otherwise be. The strong dollar that has been pressing silver down from its January all-time high. The yen weakness that forced Japan's intervention on Thursday. And here is the complete picture that matters. The forces pressing silver down right now are high inflation, Fed can't cut, strong dollar, silver headwind. Every link in that chain runs through one 21-mile wide waterway off the coast of Iran. The forces pulling silver up are structural AI industrial demand growing 77% year over year, inelastic to silver's price. A Fed institution under internal and political stress that quietly benefits hard assets over time. A dollar facing pressure from multiple central banks simultaneously. And a physical silver market running a 6th consecutive year of supply deficit. Temporary pressures pressing down, structural forces pulling up. That's the complete picture. And silver at $75 on a Friday close, after the most eventful week of 2026 by most measures, is exactly where a market in that kind of tension sits while it waits for resolution. 2 weeks, 3 dates. Here's exactly what to watch. Friday, May 8th, April non-farm payrolls. This is the first full employment reading since the Hormuz conflict fully escalated. March added a better-than-expected 178,000 jobs, while the unemployment rate slipped to 4.3%. ADP has reported average weekly private payroll growth around 40,000 for April, indicating a healthy but less than robust jobs picture. If April comes in below 130,000, the economy is strong. No need to cut argument weakens materially. Watch this number carefully. Friday morning. Silver's reaction within the first hour of trading will tell you what the market actually believes about where policy goes from here. Monday, May 12th, April CPI. This is the most important single data print for silver between now and summer. April captured Brent crude above $100 for most of the month. If that flows fully into consumer prices, we could see CPI at 3.5% or higher, another headwind. But watch the energy component specifically. If the oil pullback that started late this week shows up in April's energy prices, the headline print could surprise to the downside. A downside surprise on CPI is one of the most powerful short-term catalysts for silver on the calendar. Be ready for either direction. Thursday, May 15th. The Warsh era begins. Kevin Warsh is confirmed as the new Federal Reserve Chair. His first public statement and press conference as chair will be analyzed word by word. One sentence about the rate outlook could move silver $3 in a session. Know this is coming. Have your price levels established before it arrives. Key price levels to hold in your head. Support, $72. Tested and defended 3 times since March. A 4th test and hold would be one of the most significant technical signals of this entire correction. Resistance, $76 to 70 cents. Silver needs to break and close above this level to shift the short-term picture. Bull confirmation, above $79 to $80 on a daily close. The bias turns meaningfully positive. Here's what I want to leave you with, because I think it's the most honest summary of this week. Silver went from $76 Monday to $75 Friday. And inside that single dollar move, you had a 30-year record for Fed dissent, a hawkish double punch from inflation data, A GDP print showing the economy is being held up by the exact industry that needs silver most, $725 billion in AI capex commitments that are inelastic to silver's price, and a Japanese government intervention that rescued the weekly close from $71. If someone had described all of those events to you on Sunday night and asked, where will silver close Friday? Would $75 have been your answer? Probably not. You might have said $65 or $85. The actual answer was $75 because that's where two equally powerful and opposite forces reach an equilibrium. The forces pressing silver down are temporary. They have names: Hormuz, strong dollar, higher for longer Fed. All of those have endpoints. The strait reopens. The Fed eventually pivots. The dollar eventually weakens. The forces pulling silver up are structural. They don't have endpoints. AI infrastructure demand growing year on year, a sixth consecutive annual supply deficit. Central banks around the world gradually building hard asset reserves as insurance against institutional uncertainty. $75 silver is a temporary equilibrium, not a verdict. The next catalyst that resolves this in one direction or the other is coming. May 8th, May 12th, May 15th. 3 dates. 3 potential inflection points. And you now know exactly what you're watching for and why. Subscribe and hit the bell if you want the reaction analysis the morning each of those numbers drops, because the way silver moves on each of those dates will tell us whether the transition is beginning to resolve. And if you found this breakdown useful, share it with one person who's been watching silver this week and feeling confused by the mixed signals. The $75 close was not nothing. It was a story. Now you know all 5 chapters.